Is it raining anywhere else? Matt, was that it's raining in Apple Valley?
Not down here.
It's coming down a little bit here. Just started sprinkling.
Yeah, it's raining here. It's cold.
Hasn't started in Lakeville yet, so I'm sure we're next.
That's where I am too.
It's coming our way.
Yep.
Nothing in Bloomington. Must have passed us.
I got a little bit in Egan.
We could be little weather people coming up here. Where's everyone else? Is it raining there?
I don't know. I didn't know it was supposed to rain, and I was going to take a lunch break to WALK the dogs, and
Nice play there.
yeah, I it's not going over so well because now I don't know if I'm going to be able to.
I like the spelling, and we do the same. Well, actually, we just say dub. I'm gonna
What
take
was
the dogs
that?
for a dub. I can't even spell. I say that I'm gonna take the dogs for a dub
Oh,
because they started to learn how to spell.
okay.
They hear WALK. They know what that means. It's insane.
Mine haven't picked up on that yet, but they're not very happy this morning that we haven't gone.
What's
Well,
up,
enough about
everybody?
Dogs and rain. Colin, it's your turn. Take it from here.
Yes, sorry, I'm running a few minutes late. Let's get this thing started.
Were you having trouble with the mask?
Yeah, I know. I've got some other masks that I'm thinking would be good, you know? All right, shoot. Let me do this. Screen 2. Okay. Hey, thanks everybody for being here. If you have not been in these meetings before, this is supposed to be super interactive. So if you guys have questions, do not hesitate. Just say, Colin, shut up. I have a question. Jump in here. Ask away. These Wednesday trainings are always the best when you guys engage and feel like you can come away from this with a better understanding of this side of the process. So to be honest, I've got some stuff that is a little bit boilerplate, and then I kind of went off the beaten path, and I'm going to show you some redacted documents that I think would be valuable in you understanding things like closing costs, things like escrows. So I'll be bouncing back and forth in terms of what I actually share on the screen, but that's why this is beautiful that this is on Zoom where you should be able to see. So let's get started here. We started doing this 2 weeks ago where we went through 20 questions that first-time home buyers wish they should have asked. And it was overall a good session, so good that we only got through 10 of them. So I thought this would be a good opportunity to do the last 10. And when we talk about, let me just pull up docs that I'm going to need here as part of the process. When we talk about what's included in the monthly mortgage payment, let's start there. That's question 11 out of 20 here. So you've got principal and interest on the loan. That is always going to make up the lion's share of the overall monthly payment. Then if the borrower is escrowing, which means they're including their taxes and insurance as part of the monthly payment, 1/12 of the tax figure and 1/12 of the homeowner's insurance figure will be included in the escrow account. And then the last thing is mortgage insurance. If the borrower has mortgage insurance, that is going to be included in their monthly mortgage payment. You might notice what's missing here is HOA dues. Whenever you have a property that has HOA dues are never, ever, ever included in the monthly mortgage payment. Now, they're included for qualifying, obviously, in terms of what the actual monthly housing ratio is, but you will never pay HOA dues as part of the monthly mortgage payment. Let's take a look at an example here on one of these redacted closing disclosures. And I'm going to come back to this frequently throughout this presentation so you can get a breakdown. I know you've probably all seen these, for your buyers. But this is a good sort of breakdown where we can really get into a real live example of what this looks like. So can everybody see my screen okay?
Yep, I can see
Yep.
it.
Thank you. Okay. So for example, this is a $520,000 purchase. The borrower is putting 10% down. The borrower is going to see their projected payment and payment calculation. Okay. Years 1 through 10, principal and interest, $29.58. You've got the mortgage insurance that's on here, which is $160 a month roughly. And then their escrow, which includes 1/12 of the taxes and 1/12 of the homeowner's insurance. You might notice that on loans with mortgage insurance, it will break out the years in which the borrower pays the PMI and does not pay the PMI, right? So they're estimating at 10% down, the PMI is going to be on there for 10 years. Probably not, but that's maybe a conversation for something later down the road here. And then you notice that this $160 falls off in years 11 through 30, because on conventional loans, mortgage insurance will fall off automatically once the borrower reaches a 78% equity position in the home. So when you talk about what's included in the monthly payment, both the loan estimate that the borrower will get from the lender and the closing disclosure will break out loans with PMI, loans without PMI, and then it will say when that PMI is roughly set to go away. But when you talk about those 5 key components of what's in a mortgage payment, principal, interest, taxes, insurance, PITI, right? And then mortgage insurance if applicable. Any questions on that monthly payment? Cool. All right. I'll drag my doc over here and we'll, all right. Gift funds. So this is a popular one. And I don't love this graphic, but when you talk about gift funds are applicable on just about every type of loan out there. Okay. So if you're doing 3% down conventional, you can get 100% of your gift funds and down payment. I'm sorry, 100% of your down payment and closing costs, those can come from gift funds. Same with FHA, same with VA. If you have VA where the veteran is paying their own closing costs and they need a gift for that. Matt had a transaction that was like that, where they got a gift just for the closing costs. USDA is also 0% down, but they can get gifts. Some jumbo programs will allow gifts. So there is no hard and fast requirement that I need my own money. The key is that when a borrower or buyer is getting gift funds, that it needs to be sourced. Okay. So I'll tell you how we do that on the back end. It's actually quite simple. The borrower and the donor. So let's say mom and dad are giving Mr. and Mrs. Buyer a gift. Okay. They're just going to fill out a gift letter that has the subject property address, the city, state, and zip. And they're saying that the donor is giving a gift of $20,000 to the borrower below without obligation expressed or implied to repay this sum at any time. Okay. They fill out the donor information. So mom and dad say, this is where I live. This is our relationship to the borrower. This is who's getting the gift. Boom, done, etc. The money is then transferred into the borrower's account in most cases. And there's a paper trail that shows the money leaving mom and dad's account and going into the borrower's account. Now, there's actually an easier way to do this, but we don't need to muddy the waters with this. What I wanted to circle back on is this here. You know, because a lot of times buyers will say, or mom and dad will say, well, why do you need all this stuff? Like, why do you need to know that the funds are transferred? Why do I need to sign this? That's a gift. Does this report to taxes? Which the answer is no, right? But the reality is why gift funds need to be documented is so that it is a known gift with, and this language becomes important, no obligation to repay the sum. In other words, let's say you have a borrower that's right at their maximum debt to income ratio. Underwriting wants to know if they're getting a gift from a donor that they don't have to hit them for a payment because it's actually a loan, right? Because if it were a loan that they were paying $400 a month on for the next 180 months, well, that might put the borrower over the DTI limit. right? So gift documentation is simply to ensure that the money is not obligated to be repaid. Does all that make sense? Any questions about gift funds that you have received, or things about gifts that you might have questions on?
Are there any timing stipulations on gifting of funds?
Say more, Angie.
Like, does the gift have to be in the person's account for a certain amount of time before closing?
That's a really great question. And like most things, it depends on the type of loan. Okay, so I mentioned that, you know, the typical way this is done is that gift funds are transferred from the donor account to the borrower account, and then there's a paper trail, which means, okay, we see the check left the donor's account and went into the borrower's account. That's required on government loans, that we have to show the money leaving one account and then entering the other account. And usually it's just within underwriting turn times. So that can be done 5 days before closing, right? But
Colin,
yeah,
isn't there a seasoned amount of time that has to be in the donor's account as well?
no, absolutely not.
Okay.
So seasoning, I'm glad you brought that up, because seasoning of funds is more related to that underwriting doesn't see that it's actually a gift. Okay, those are actually two excellent questions, right? So let me give you a little mortgage history here. In 2015, all right, there was underwriting standards became looser. Fannie Mae and Freddie Mac came out with this thought that we will do a 5% down conventional loan, okay, but it must be the borrower's own funds. All right, so think about how far we've come. Now we allow gifts on 100% of loans, right? But it used to be that a 5% down conventional loan, we got to see 2 months of your bank statements that show that you have the 5% in there. Okay, so what did that lead to? It led to a lot of seasoning. Hey, I'm getting a gift from my mom and dad. Okay, well, as your loan officer, what I'm going to tell you is this. I'm going to tell you to get that money in your account way before you start shopping for a home. And then we'll never see the transfer from mom and dad. Okay. A lot of times you'll still see seasoning requirements on investment properties, right? Because the rule is no gifts on investment properties, period, pretty much. Okay. So if it's like, hey, I want to buy an investment property, but I need cash from my mom and dad in order to do that. Okay, well, put it in your account. And then after a month or two, it'll be your funds. So those seasoning requirements are more for that purpose now. But the idea that the funds need to be in your account so that we don't see all this, now it saves the headache, Cassie, right? It saves the headache of having to do paper trails and things like that. But there's no hard and fast requirement, back to Angie's question on that. One more thing I wanted to note. The funds have to be transferred, and that can be kind of a pain for the donor, especially if parents are of a certain age, right? On conventional loans, the easiest way to do is that mom and dad are giving me a gift for $20,000. Mom and dad write a cashier's check made out to Joe Homebuyer and Flex Title, or whatever title company the buyer's using. They bring that cashier's check to closing. This document that you still see on my screen will say date of transfer at closing. And on conventional loans, we don't need to see the money leaving the donor's account. So that can be helpful. And I'll coach up, when you have conventional loans, that can be the easiest way to do it, where you just get a cashier's check from mom and dad made out to you and the title company, bring that to closing. We don't have to see any of the donor's information, bank statements, nothing like that, if we do the transfer at closing, but conventional loans only. Does that make sense?
Yes, thank you so much, Colin.
You bet. Any other
I've got
questions
one
on
for you.
gifts, guys? Yeah.
Does the donor have to be related, or could it be a family friend that is considered family?
Um, I have done them with a close friend before, which has surprised me. Okay. Go back to 2015, 2016 is like, you got to be a blood relative, right? I think a lot of that has loosened. But remember, the big thing that HUD, especially on FHA loans, wants to get away from is, Dustin, you're the buyer's agent and you're also the donor. So, those guidelines are loose, a lot looser than they used to be. Blood relative is always super safe. But I have seen gift letters approved from close friends before. I mean, it used to be that, I'll tell you a story. So when I bought my first house, I actually did the loan by myself, and I had to get gift funds from my now wife, and we were not engaged at the time. And the mortgage lender that did it told me, hey, we're going to send a gift letter over. And the only thing is that Nicole's going to have to be listed as your relationship to the recipient applicant as your fiance. I hope that doesn't put any pressure on you. So, I mean, it used to be very, very stringent in terms of, what that relationship is. It's loosened up quite a bit, but always good to have that conversation on the front end, D-Dub. All right. Why is this? All right, let's talk about loan to value. I'll really briefly touch on this. This is pretty easy. Loan to value, loan amount over value of the property, right? I think everybody understands loan to value pretty well. I will note that it says value of the property, right? So if you have an appraisal that doesn't hit the value, the LTV will change. If it does not hit value on the low side, then your loan to value will be thrown all out of whack. If you have an appraisal that goes above and beyond the value of the property, the loan to value doesn't change. In other words, the rules are sort of rigged against us, where we can't say, oh, it appraised at 305,000, or give you a different example. It appraised way over asking. So now I can get a reduction of my PMI, right? Or I can get a cheaper rate or whatever. No, it is ultimately either the purchase price or the value of the property as appraised, whichever is lower. One thing can do is, let's say that you have a loan that appraises over, right? And if you would want to write a change of the purchase price and finance closing costs, that is something that we can do. Haven't done it very often, but that is something to keep in your back pocket, that if you have, let's say, a $300,000 purchase price and a $305,000 appraisal, and you say, wow, it appraised higher, let's take the purchase price to 305 and have the seller pay $5,000 in closing costs. That can be done with an amendment. So just some kind of real basics on LTV. Don't want to spend too much time here. Questions on LTV, anybody? Awesome. All right, let's talk about PMI. A lot of people say, is that homeowner's insurance? No, it's not. Does it protect me? No, it doesn't. Well, what does it do? Well, it protects the lender, right? So if you actually end up defaulting on the loan, that private mortgage insurance on conventional loans, or mortgage insurance that is government paid on FHA loans, it actually protects Fannie Mae, Freddie Mac, and HUD. It protects the good old government in case your loan goes bad. Usually required, you put less than 20% down, many options to fit your needs. Wow, I like that boilerplate language. So I wanted to do a little bit of a deeper dive on this, okay? PMI, I won't get into USDA loans, but PMI, generally you have two different loan types. You have FHA and you have conventional, right? VA, you've got no PMI. How is the PMI calculated? Well, on FHA loans, it is a flat number regardless of your credit score or LTV. And the way that calculation goes is that you actually pay 0.85% of the loan amount over 12 months. So it's actually a big old math problem, okay? If you have a $375,000 purchase price, 3.5% down, the loan amount is 361,000 and change. The way the PMI calculation is just 8.5, geez, I can't get the numbers right. 0.85% of that, $3,000 is what the mortgage insurance premiums are annually. You divide that by 12, $256 a month. Okay, that's pretty expensive compared with what you typically see on conventional loans. But you can have an 800 credit score, you can have a 700 credit score, you can have a 600 credit score. The PMI on FHA loans will be the same, and the rate will largely be the same. So you see why FHA loans are good products for people with less than perfect credit, because it doesn't discriminate, for lack of a better word. It doesn't hammer you for having a bad credit score. It is simply a flat number that's applied across the board, right? That's different than a conventional loan, right? A conventional loan will use two major factors to determine what the PMI is. Why would it pull up when I hyperlink to it? Why would we want to do that, right? So what I'm going to do is I'm going to show you a big old matrix here, which will look daunting and intimidating at first, but let me walk through it, and it should get pretty easy. Wow. Okay. So if you look at how PMI, remember we just talked about how FHA loans, doesn't matter if you're at 800, doesn't matter if you're at 700, doesn't matter if you're at 600, the PMI is all the same. It's just that simple calculation of the premiums divided by 12, right? On conventional loans, the two major factors that are used for calculating what the PMI is loan to value and then credit score. So you think about this matrix. Can everybody see this okay? So, for example, 3% to 5% down, you've got one area of coverage. 5 to 10% down, another area. 10 to 15% down, and then more than 15% down. The numbers are inverted because it's loan to value versus down payment. So down payment is one portion of this, right? The other portion of this is credit score, and it will go in 20 point increments. So 800 is the best. Then you get down to 780 to 799, 760 to 779, and so on and so on. But it goes in these little 20-point steps, right? So if you think about a comparison, right, you've got a borrower that wants to do, let's say 5% down conventional, and they've got a 740 credit score, right? Well, unless they absolutely have to go FHA, it's going to be a lot cheaper mortgage insurance for them, because this number here is 0.29% in premiums. On FHA, it's 0.85% in premiums. So on that same loan that we just talked about for FHA, you know, if they did a conventional loan, their mortgage premiums would be a third of what it would be versus FHA, right? It doesn't take advantage of the higher credit score to go FHA, right? So typically with conventional loans, if you have a borrower that is above 680, right, because it gets a lot more expensive at 679 here. But if you have a borrower that's above 680, the mortgage insurance premiums are almost always cheaper than FHA. That's why 680 is the most important number in all lending, because the rate and the mortgage insurance gets way cheaper once you get above a middle score of 680. That's a lot of numbers. Any questions about this? I know we're a little bit in the weeds. You're hopping on here saying Colin's got me looking at PMI rate cards. What is going on here? So let's talk about closing costs. All right. And I actually am going to pull up the redacted CD that I have here that is going to come up. Let's see what so all mortgage loans have closing costs. Lenders are required to give you a detailed estimate of these fees, combination, buyer, seller, or both in terms of costs. Closing costs can be gifted by a family member or paid by a credit for the lender. All right. So we did this exercise about 5 months ago, and it actually turned out pretty well. But can everybody see this PDF document that we have here?
Yes.
Yes. All right. So typically when you have costs that break out, they break into a number of different categories. You're going to have origination charges that are going to be in section A. That's where you'll have companies like Rocket, for example. I always pick on them, but they might charge 2 points, 2% of the loan amount, and suddenly you're paying $8,000 in section A before you know it. Okay. So section A is always going to be the key when you have borrowers that are comparing on price, right? You might have somebody said, well, I can get 6.45% if I go with this company. Well, how much is that loan actually costing you? What do you mean? Well, look in section A. How much are they charging you? Oh, they're charging me $9,500. Oh, okay. Well, we're right here and we're only an eighth of a point more. In other words, you'll have lenders that will play games a lot, that will go for the lowest rate without a conversation of, do you really A, have that money, and B, does it make sense for you to do a giant point buy down if, as we discuss often, you might refinance that loan in a handful of years. Section B is going to be things like appraisal, credit report, flood certification, tax service. Section C is going to be services like closing fee. Title fees is always what you're going to find in section C, Charlie, of the loan estimate. So A, B, and C, this kind of first page is, okay, if I close the loan and I refinance it in 30 days, am I going to get any money back? No. Typically, these total loan costs are things that are one-time transactional costs that pertain to the loan. All right. That's section Echo 2. So you've got, for example, mortgage registration tax, you've got recording fees, et cetera, et cetera. But I wanted to talk about escrows for a moment. And I thought this would be a good illustration of escrows in terms of how they actually work. Before I get down that road, I wanted to talk about escrows. Did anybody want to, we can come back to sections A, B, and C, but if we talk about how this is actually read, anybody have questions or anything that jumps out at them just on this first page of the CD? All right, all good. So an escrow account, right? Escrow account is established by the lender on behalf of the borrower so that taxes and insurance can be paid by the lender when those bills are due. Property taxes in the state of Minnesota are due in May and October. Okay. And insurance is always something that renews on your homeowner anniversary, right? So you buy a house on October 12th of this year, you escrow for insurance, the insurance policy automatically renews so that you are not stuck with your house that is uninsured. We talked about 1/12 of the annual taxes and insurance. When the insurance or property tax bill is received by the lender, they will use that money from your escrow account to pay the bill. One important note on this, it doesn't mean that the county's not going to send you as a buyer a tax notification in the mail. Happens all the time, usually in February or March, where a buyer will say, well, what the heck? Hennepin County just sent me a notification that I owe this amount in taxes for this year. I thought that that's escrowed. And the answer is yes, but the county's still required to give you a tax estimate in the mail. So if you have that, or if your buyers have that, don't freak out. It's more a conversation around, this is a county requirement to disclose what the new annual taxes are for your property. All right, so why are escrow accounts valuable? They help to budget payments, right? If you are, the goal here is that if you add a cushion in, and we'll talk about this in a second, if you have a couple extra months that are squirreled away in your escrow account and your property taxes or insurance go up, the goal is that that is paid for out of the escrow account overage before they start tapping into your monthly payment. So your taxes go up 20%, your taxes go up 10%. Okay, but my payment is supposed to be X, right? To keep your payment as close to as it was when you closed a loan, that's why escrow accounts are pre-funded, okay? Escrow accounts ensure lenders do not run the risk of delinquent tax bills, right? Okay, we have somebody that's not escrowing, they're paying their monthly payment, but they forgot about taxes, right? Suddenly they're 2 years behind, there's a tax lien on the property. It's bad news for everybody, right? So how these escrows are structured is actually pretty interesting. Wisconsin's totally different, so we won't get into that. In the state of Minnesota, the way this is going to work is that the buyer pays 12 months of the insurance up front. So they pay for an entire year from the time they close through the next year. All right. And then people will say, well, what the heck? I paid for an entire year up front. And then not only that, but I'm paying, 1/12 of that as part of my monthly mortgage payment. Yes, you are. And the thing is that an escrow account for insurance typically functions like a gas tank, right? Okay, so you pay 12 months up front, and then every month you're paying 1/12 of the insurance premium in order to, at the time that your homeowner anniversary comes up, you have enough money in the escrow account to pay your insurance forward again. Now, on the sell side, it's important to note that, let's say that, oh, I just paid my insurance for the next year, or my escrow account just paid my insurance for the next year, but I'm selling, in 2 months. The insurance company will credit you back that 10 months that you have prepaid, but you are always paying 12 months in advance for insurance. And the goal is that you never want to have a situation where the house burns down and the house is not insured. When it comes to taxes, it depends on the time of year that you are closing. And I wanted to use this as an example because this is something that closes on Friday. Okay, so 10/14, the property taxes, the buyer actually asked, they said, hey, I looked at the title work. It says second half taxes are due on October 15th. Do we need to pay that? And the answer is, in this time of year, no. They are simply escrowing 4 months of these taxes. And then what's happening is that the seller has already paid the county taxes from the time of closing until the end of the year. So it becomes a proration of those 75 days that is accounted for at closing. It becomes another line item closing costs in this adjustments and other credits section where, hey, we know the seller already paid the second half taxes, but they're not going to live there the final 75 days of the year. Mr. and Mrs. Buyer, you owe that difference there. It's different than they're not picking up the entire 6 months in their escrow payment at closing. And the reason why this is 4 months is because if you think about it, they're closing on October 14th. Their first payment is December 1st. December, January, February, March, April, right? You're going to have 8 months of payments in the escrow account so that when the time comes that the first half property taxes are due, April of next year, the escrow account disperses, right? So they're paying these property taxes, they're paying into the escrow account, and yes, they're paying monthly, but the way the escrow account is calculated is to make sure that there's enough when it comes time to pay taxes the next time they're due, which is going to be either May or October. That's a lot, guys. Any questions on how escrows function or escrow questions you've had from buyers? Okay. All right, cool. Just a couple more and then we'll wrap this, guys. This one, what happens when you apply for a loan? Lender verifies loan applications, submit it to underwriting, order the appraisal if there's one required, which we should circle back and do one on appraisal waivers, which maybe we'll put into our training. Title works ordered that reviews and clears any title issues. Once your loan's approved, your closing is scheduled. This is a good one in terms of responsibilities as a buyer during the closing process, right? The lending process. You know, these are some obvious ones: changing jobs, going self-employed, quitting your job. Does everybody know how the verbal verification of employment works? Verbal verification of employment is something that can trip some people up. So when you get a clear to close, the lender still will call, usually 5 to 7 days before closing, and verify that the buyer still works there. Okay, so a lot of times it's like, hey, everything's clear to close. Great, now I can quit my job. That's not something that you want to do. And so whenever I have somebody who's like, hey, congratulations, you're clear to close, please don't quit your job. We have heard these horror stories about deaths like cars, boats, furniture, using your credit cards excessively, spending money that you have set aside for closing, keeping your credit history steady, not applying for loans. Again, once the loan closes, you can do whatever you want, right? Change bank accounts, large or unusual deposits into your account. That's a key one. You know, hey, we want to move all the money into one spot just to make it easy for the lender. Well, okay, now all those transfers that are into that bank account, we need to see all the paper trail for that. So that's something we try and coach people up on. Co-sign or co-borrower, that's a pretty obvious one. You don't want to co-sign on another loan while you're in the
I
middle of the
know
lending process. Yeah.
this sounds crazy, but I also tell my buyers who are selling that they need to continue making their mortgage payments. I had a seller once who thought that once she went under contract, she no longer had to keep making mortgage payments. Just when you think you've seen it all, that, I mean, it really, I mean, it's something I now advise all my clients on. You have to continue making your mortgage payments. It's not something I ever thought I'd have to say, but I ran into it once and it derailed a lot of people.
That's a big one. That's a big one, you know, especially when you have closing dates that might get delayed, right? Let's say that you know, well, let's use this one on Friday, for example. Okay. You know, oh, we're actually going to push this out. Well, we didn't make our October payment because we thought we're closing in October, right? Now we're closing in November. All right. Well, if you haven't made the October payment, you've got 30 days to make it, right? And now suddenly, well, whatever, I paid the loan off, doesn't matter. Now you might have a 30-day late on your credit report, which is going to hammer your credit, and it, you know, it could affect your ability to qualify for a new loan. So that's a great one, Cassie. Final walkthrough, you guys know what's up with that. And then, you know, you've all seen, for example, Flex Title sends notifications to borrowers. Typically, they're wiring instructions. Flex Title will take a cashier's check. Most title companies do. You know, sometimes these numbers can change, right? So, I mean, typically, it's not a bad idea for buyers to come to the closing with a personal checkbook in case numbers are off by 10 or 15 or $100, right? And then I get asked a lot, why do these numbers change? Like, why is it that we go through all of this, we get a closing disclosure out, we've got numbers that, you know, oh, okay, we know. And the answer is most of the time, yeah. But sometimes you'll see numbers change. Why do they change? A lot of times you'll see changes on condos. Okay. The reason for that is because you might have an HOA setup fee. You may have to prepay HOA dues. as part of closing. So condos are a big one in terms of your cash to close number fluctuating in even the final week of closing, especially on quick closings. The other thing you got to remember is that title is working with another title company. So we may have our stuff together all the way, but if the seller's title company doesn't have accurate numbers, in regard to things like water bills, in regard to things like HOA dues letters, that can change the numbers, right? So good idea to bring ID, cashier's check, or have the wire set up, and then personal checks, because a lot of times on those PUD properties with HOA dues, you will see numbers change. Contingent offers, had a conversation about this morning, in terms of what if you have somebody buying and selling on the same day? They're going to sell in the morning and they're going to buy in the afternoon. Do they need to go run those net proceeds to the bank, deposit it, set it all up? The answer is no. The title company will handle all of that. So let's say you have somebody that's getting 90 grand from the sale of their home and they owe 60 grand on the new down payment and closing costs, right? What's going to happen is that the title company is going to apply those net proceeds directly to the bottom line and then cut a check back to the buyer for the difference. So as contingent offers come back, it becomes a lot easier when you have the entirety of the net proceeds that is covering your down payment and closing costs on your new purchase.
Colin, something we should note there, though, that's why it's so important to use the same title company for your sell and buy. What Colin's describing can only happen in the event that the individual is using the same title company for both closings, right? And you would say, well, why wouldn't someone? Oftentimes a buyer might be doing a new construction home, and the new construction always leans towards wanting their title company rep to do it. So oftentimes when I represent a buyer who's using a new construction lender, when we're using their title company, I might have them handle both closings for this scenario. Otherwise, you can run into a problem where they used one title company, they get the check, the other title company might not take that check, or a wire might not get transferred in time. So to Colin's point, yes, that can all happen seamlessly, assuming you are using the same title company for both transactions.
Cool. She looks so happy in this. I think that's a great point, Cassie. I think that is something, and not to mention, it's just easier for the buyer to sign in one spot if it's the same day or multiple days. All right. Anybody, I know we went through a lot of different stuff here. Thanks for the great questions. Anybody want to talk about anything here before we wrap this thing up?
Good stuff.
Cool. Thanks to everybody for being on board. We are around with questions. Thank you all. Have a great day.
Thank you.
Thanks, Colin.
Thank you, sir.
Thank you.